Go through the outfits that I wore with me as a private equity fund manager. Yes, I run the fund, so I can wear whatever I want. Okay, while we go through these outfits, I want to talk about something that you may have been hearing in the news, the shadow banking system. Yes, the shadow banking system, it is not illegal. It's just a banking system that doesn't happen at a bank. No FDI insurance, way less regulation, and way more flexibility. This includes things like private credit funds, hedge funds, money market funds, and non-bank lenders. Basically, where capital goes when traditional banks either can't lend or they won't. So let me give you a little bit of history. After 2008, banks tightened up more rules, more capital requirements. So the market adapted and trillions of dollars moved into the shadows. Now fast forward to today. We're in the middle of a private credit crisis. Over the last decade, companies loaded up on cheap debt, low rates, easy refinancing. Now rates are way higher, liquidity is very tight, and a massive wave of debt is coming due. That's called the maturity wall. I've told you about that in the past. We got a real estate maturity wall coming and a private credit maturity wall coming. So companies now have three options: refinance at way higher rates, sell assets, or default. And you already know that's pressure building. But here's the part most people are not going to be talking about. A lot of this debt is sitting inside private credit funds, not banks, which means the risks show up differently. These funds don't trade daily like stocks, and they don't always have transparent pricing. So how do they value their assets? They use internal models. So basically the funds are pricing the assets themselves. They're pricing the assets that they're holding. They're using assumptions, comparable deals, and sometimes third-party estimates. But there's no real-time market saying this is what this is worth right now. So the value you see, it's not real. I don't know what you want to say. It's smoothed out, it's lagged, and in some cases it's way more optimistic. So this means portfolios can look stable on paper even when the underlying assets are under pressure. And it gets deeper. A lot of these funds are also limiting withdrawals right now. So if investors want their money back, they may only be able to take out a small percentage at a time, meaning you can't exit easily, you can't always price it accurately, and you may not see the risk until it's already there. Fun fact, this same dynamic showed up in 2008. It wasn't just bad loans, it was opaque structures that delayed pricing that nobody understood. That made the system look fine until it just wasn't fine. Different names today, same mechanics. So what should you actually do with this? Watch where valuations don't match reality, watch refinancing pressure, and watch where liquidity starts to disappear. Because when liquidity dries up, that's when prices catch up to truth. And so to understand this, you want to make sure you're on my newsletter. I just sent a fire newsletter today. I literally getting a lot of calls and text messages about how good this edition of the newsletter is, but I go in depth to show you how all of this is going to show up in real time in your life, as well as if you're an investor or a trader and what to do about it. So comment newsletter down below and I'm gonna send you the link so you can get on the newsletter. And I got a bunch of newsletters, like if you're new when you join, I got a bunch of newsletters that I'm going to send out to you so that you can get all caught up. So comment newsletter and you get on the list absolutely free.